Hi and good day, everyone. This is Alberto Pau from Tomorrow in Trading. I have the great pleasure of having with us today Mike McDonald from Cross Asset Technical Strategy. Hi, Mike.
Hello, Alberto.
Hi, and thanks again for being here.
Oh, no problem, no problem.
Mike is one of the very few industry professionals who have been on both sides of the fence. And what do I mean? Mike will tell us a little bit more in detail in a minute. He started as a trader with some of the largest trading houses here in London and in Asia. Namely, he started trading Forex for, at the time, was one of the biggest desks at Lehman Brothers. He then spent a number of years with a research company as a research analyst, and then finally came on to forming Cross Asset Technical Strategy, which is the research firm he owns and runs at the moment. So he's one of the very few people who have been in this industry, not just from a hands-on, in the trenches trading approach, but also from a research approach. In other words, he's one of the very few people, and that's one of the reasons I have such a great pleasure of interviewing him today. He's one of those few people who have looked at the market from a more perhaps in-depth and theoretical approach, and specifically today we'll talk about Fibonacci retracements, but he also knows what it feels like to have small and big positions open alike. So he understands what what all the challenges we face as traders in terms of risk management, psychology, and so on and so forth. That's enough from my side for now. I will let Mike perhaps spend a couple of minutes telling us a little bit about what kind of brought him to finance, to the fantastic world of trading, and yeah, perhaps give us an overview of how you got to where you are today, Mike.
Okay. As you said, I started in Lehman's. I basically started by answering an ad. I'm a maths graduate, and an advert came up saying, "Can I solve equations?" I said yes. I eventually went down for an interview. It all turns out that this was a recruitment company. They gave me an interview with Lehman's. I sat with the FX desk for an afternoon, and they hired me in. Excuse me. So I started at Lehman Brothers. I was working on the Deutschmark French franc desk. I was the assistant trader, or the trader's assistant. And the positions, as you said, they were huge. I mean, we were talking about an intraday long or short position of about 1 billion Deutschmarks either way. So you can imagine the flows that were coming in and out of my boss's desk. I was trying to oversee these positions on an intraday. The overnight proprietary position was long or short, 250 million Deutschmarks. So the positions I started with were quite phenomenally big. And it's also worth knowing as well that Lehman's were very aggressive. So when my boss decided that the trend was turning, he would aggressively push the market. He would hit the market for everything, and then he would just basically turn the thing around, and it would go the opposite way. So I think each day we were going through about maybe 15 billion, 10 billion Deutschmarks each day was going through his book. So that's the FX positions I was looking at. After Lehman Brothers, I spent a short time in NatWest. Sorry.
For those who are not familiar with Deutschmarks, it's quite a few years back for some people. How much would that be roughly in terms of euros or dollars in quote unquote today's money?
Oh, I'd say about 750 million intraday.
Interesting.
Yeah, 750 million intraday.
And so that our traders and listeners understand. So the purpose of the desk you were working with at Lehman, was it pure market making? Were you also taking prop positions? What was kind of the main goal of the desk?
Well, obviously, the main goal of the desk was to make the money.
Of course.
Yes, of course. Yes, we can all agree with. We were money markers. We were spot dealers. So my boss would be getting calls from banks all over the world asking for a price. So he would have maybe one desk in Paris ask for a position, or ask for a price in, say, $20 million. Another bank would call and say, do you have a price in $500 million? And he would make these prices, and then he would have to massage his positions accordingly to get himself back within his own risk parameters.
Got it.
So it was very, very hectic, yes.
Interesting.
Very interesting.
Interesting. Okay, and so you moved on from Lehman, and where next?
I had a short stint at NatWest, and then I moved into Forecast, the online consulting, or the research consultancy company. I joined there, I think it was 1995. I'd have to check my CV. But I think 1995 I joined there. I was a sixth person hired in, and I was hired in to basically develop the technical analysis product and also to be a technical analyst. So we started off from the very beginning. I spent 6 years in London. I worked for Forecast. My boss at the time was Anne Whitby, who's very high up in the technical analysis world. And then after 6 years in London, they moved me over to Singapore to basically beef up or provide more strength to the fledgling Singapore office. So I spent 6 years, just over 6 years in Singapore. Then I was hired in to Credit Suisse private banking in Asia, and they hired me in to set up the technical strategy desk. So from forecast, trading, consultancy, I went back into banking, into a private bank, and I set up the technical strategy desk for Credit Suisse. I was covering APAC, Asia Pacific, so I was covering the markets from India. I would go up to Japan, across down to New Zealand, down to Indonesia, and everything else in the middle. I was covering foreign exchange, FX. I was covering equity indexes. I was covering equity names, individual stocks, and I was covering commodities. So my day was quite busy. In between all of the research, I was meeting clients. I was doing business trips. I was giving presentations. I was at seminars. So it was quite a busy time.
Wow.
At Credit Suisse. Yeah.
Interesting. And this brings us to which year exactly?
Yes, and here I am. I left Credit Suisse. I spent a year sabbatical. I basically played the piano for a year. I mean, I needed a break. You know how it is when you've been in the markets consistently for so long. You just
Absolutely.
need to clear. You need to clear out. You need a complete clear out. So I spent 9 months in Singapore. All I did was just play piano, Chopin, Bach, Rachmaninoff, Liszt. I just basically cleared my brain out of all of the finance. But whilst I was there, I was still in touch with my ex-colleagues, and they said to me, keep one toe in the market. So I started just a weekly, every 2 weeks, I'd just do a few slides. I'd send them off to people just to keep my eye on what's going on. And then when I came back to London, I thought, why not just see what's happened? I set up the company, and I thought, let's see what happens. So I set up my company, Cross Asset Technical Strategy, and I've been building up over the years, and this has now brought me to where I am now.
Interesting. So I remember you mentioned when we met here in Canary Wharf, here in London, that you kind of spent some time, doing other things, learning piano and kind of enjoying life.
Yes.
And also you're now gone from, you pretty much covered most of the trading and banking spectrum. You've started as a trader, you then went on to research, and now it sounds like you're kind of going in an entrepreneurial direction, which is what actually a lot of traders are looking for, in the sense that we find that the majority of our traders and our students, yes, they do want to make either a side income or a full-time income out of trading, but once you kind of have that initial success with trading, whether it takes 1 month or 15 years to achieve, then trading becomes a business as well. It's like any business,
Yeah.
you have to invest. You will have some costs. You'll have good times,
Mm-hmm.
bad times. There's an element of risk management involved. So it's interesting how you started as a trader's, and now you're kind of you're coming back to the entrepreneurial aspect of it.
Yes.
Without further ado,
That's interesting. Yes.
Indeed, Mike, I understand that we don't have a lot of time together, so we're here today to talk about Fibonacci retracements. So perhaps for those of us who are listening who are not 100% familiar with Fibonacci, what is this whole thing about Fibonacci? Who is this guy, and why is everyone raving about him?
Raving about him.
Well, maybe I overextended myself there.
Well, I'm a mathematician, so I'm on your side. He was an Italian mathematician who came up with this sequence of numbers. As we can see on the slide, it's 1, 1, 2, 3, 5, 8, and it goes on forever. I mean, it's infinite. So he devised this. He developed this sequence, and the way he did it was to start with the numbers 1 and 1. Then he added them together to get the number 2. Then he took the number 2 and added it to its predecessor, which is 1, and got 3. Then he went to 3 and added it to 2 and got 5. He got 5 and added it to 3, so 8. Then 8 plus 5 to 13, and so on and so on and so on, ad infinitum. So this is where the Fibonacci numbers come from. But the interesting thing is that whilst we have Fibonacci numbers in nature, as a technical analyst, we aren't really looking at the numbers themselves. We're looking at the ratios, and the golden ratio, which is 1.618 and 0.618. So from a trader's point of view, from an analyst's point of view, whilst we can see that the Fibonacci numbers are in nature, they're in music, they're in art, they're in architecture, we want to look at the ratios of these numbers to give us price retracements of a move. So the way they do it is you divide one Fibonacci number by its neighbor, and you come up with a ratio. So if I go back to the slide we had initially, there's the Fibonacci sequence again. So what we do is basically, very quickly, they did 1 divided by 2, which gives a half.
Sure.
And they did 2 divided by 3, which gives 0.6666. But the Fibonacci golden ratio is actually done differently. And what Fibonacci did was he took the bigger number and divided it by its lower neighbor. So, for example, for the number 3, he took the number 2, and 3 divided by 2 is 1.5. Then 5 divided by 3, he did 8 divided by 5, 13 divided by 8, and so on, 144 divided by 89. So when he did this calculation, he noticed that the ratio was actually approaching a number, which was 1.618. And this is the golden ratio we mentioned in the second paragraph here. Now, the mathematicians also looked at 1.618, and you can play around with it. We won't do it here because it gets a bit fussy, messing around with equations. But there are another branch of these ratios which we use, and they are the 0.618 retracement, the 0.5 retracement, and the 0.382 retracement. So obviously, when we're looking at them as ratios of prices, we will actually look at 61.8% retracement. We look at the 50% retracement. We look at the 38.2% retracement. So these are the main Fibonacci retracements we use on our charts. And as you can see from the last line, they can be used on charts in all time frames. They can be used from the very, very long-term monthly charts, multi-month charts, even the decade charts. You could take a Dow chart from the from the 1900s, and you could start using Fibonacci retracements on that. And you can come all the way in, really slice in. And then you come to the very short-term tick charts. Literally every single point on the chart is in real time. It's every single price that's ever been traded. And this intraday 0 minute, or the tick chart, we can also use Fibonacci retracements on the very short-term trade charts. So you can see Fibonacci retracements, we can use them everywhere on our charts, whether they're from the very long-term charts or even all the way down to the very short-term charts.
Interesting. Very interesting. Okay, so
yes.
we have this golden ratio.
Yes.
So in nature, we found the Fibonacci numbers in a number of things. And perfect, we have some examples here. So where can we find them in nature? And most importantly, I'm the real exciting part, I guess, for everyone here is, how do we use this in trading, right? How can we, make some profits with these numbers?
Yes, how can you pluck something out of life and slap it onto a chart, essentially? Okay, examples. The famous ones we always see are for example, flower petals. And you can see in the first chart on the left, the petals all numbered all the way around to 21, which is 13 plus 8, which is a Fibonacci number. So Fibonacci numbers coming into the petals on a flower. Also on the second chart on the right, we can see counting around internally, we have 1, 2, 3, 4, 5, 6, 7, 8 on the internal petals. The external petals go around to 5, and then further out from there we have 3. So we have 3, 5, and 8. Again, Fibonacci numbers, which is quite interesting. Yes. Architecture, and apologies to any architects who are listening. I'm about to be very crass about my vocab. The Parthenon in Greece. We can see here this sketch which I found. The Parthenon, we can see it has 8 pillars of equal height, which gives the base and a total length of 8 units. Now measured from top to bottom, the height of the Parthenon is a total of 5 units. So once again, we have a height divided by a length, which is 5/8, which is an approximation to the golden ratio, 0.618.
Right.
Now also, because 5 is also a Fibonacci number, it's 3 plus 2. We can also see that the height of the pillars are 3 units, and the height of the roof is 2 units. So once again, we have the Parthenon, which is broken up into 2 sections of height 3 units and height 2 units. So again, the Greeks, and they are very famous in maths anyway. They basically developed what we now know as classical mathematics. So we see that they have already been using these numbers in the distant past. Also music. There we go. A piano keys. The full octave from C to C. We see it's 8 white keys, Fibonacci number. It's 5 black keys, 2 plus 3, and the whole octave from C to C, one cycle of notes, is 13 keys, 13 notes, which is also a Fibonacci number. So we have Fibonacci numbers in the splitting of the octave as well, which we see here. So then we take it from the real world and we put it into our real world, which is the FX markets. And this is where it moves. As I said, it moves slightly away from the Fibonacci sequence itself, in that we're not looking at the numbers, we're actually looking at the ratios themselves. So if we look at the first one, this is a very long-term chart we've got here. Do your clients know about quarterly charts, Alberto? I know they're very long term.
Yeah.
Yes. Okay.
But I think it's fairly self-intuitive. So for the sake of clarity, quarterly charts is a chart where every candle represents a quarter of the year or 3 months.
Yes. Yes, exactly. It's every candle there represents 3 months of data. And whilst an intraday trader wouldn't use quarterly charts, I mean, in fact, very, very few traders would use quarterly charts to make for a trading decision as such. The quarterly charts are very useful in the big picture, in that these are the charts that the Bank of England will use, the Federal Reserve will use, and they will look at these long-term charts just to get a sense of where the market's moving. So whilst a trader won't necessarily use this chart to make a trading decision, I think it's just interesting to know that the big players, the pension funds, the asset management funds, the hedge funds, the central banks, they use these charts, and the central banks will make policy decisions based on what they see. So it's always interesting just to see what they're seeing as well. So for example, on this chart now, on the euro-dollar chart here, we see that the euro-dollar rally from 2000 down here, it rallied all the way up to just above 160. I think 160, 150 rings a bell in 2008. So this essentially 8-year rally was then corrected. And we see how the first correction down, we hit the 23.6% initial retracement. This subsequently fell below the 38.2 before bouncing back. Then we hit the 50% retracement in 2010. You see the circle part there, how it tested it. It came down, bounced back up, and then rallied up. Then it came down again in 2012, and we tried again here. Once again, we bounced, and then the third time we hit, and this time we broke. It was at 3 strikes and you're out. So we had one test of the 50%, a second test of the 50%, and on the third test, it broke, and it broke quite convincingly. We had a very sharp fall, and then prices, we entered this broad consolidation phase around the 61.8% retracement, which is what we've been seeing since 2015, 2016, and now we're starting to bounce a little bit higher. So the question that from looking at this chart, the question which the central banks and the big players will be asking is, do we have potential to go down to the 76.4% retracement, which is what is around 100, with about parity to 101. So this is how the quarterly chart has panned out for Eurodollar, and this is roughly how the central banks will have used a quarterly chart, just to see how prices are moving around these very interesting retracement levels.
Just one second, Mike, if you don't mind. Going back to the previous slide, please.
Oh, yes.
So clearly, it looks like the next big level is going to be around parity. Looking at this chart, how could we tell how much of a strong, clearly psychologically parity on euro dollar is kind of a big deal. From a pure Fibonacci standpoint, how could someone tell how strong of a level the 76.4 is? Because looking at this chart, we've kind of, in late 1999, we broke through the parity, and then on the way up, we seem to have broken through parity again fairly easily. So to the untrained eye, and correct me if I'm wrong, it looks like around parity, there is a 76.4 level, but it looks like there's not much going on. We went down, we went back up. So from a technical standpoint, how can someone judge how strong is this 76.4, if that makes sense?
It does make the interesting thing about Fibonacci's, and we can talk about this at a later date, is that we use Fibonacci retracements in conjunction with other indicators. Right. So, for example, we would look at the 76.4 and we would say, ooh, it's around parity. So already it's going to get a lot of interest, not because it's the 76.4, but because it's parity. But the 76.4 is last man standing, I suppose, in some sense. And I think anecdotally what we get is that when we get to the 76.4, we then see stabilization around the 76.4% retracement. So for me, if I was talking to a client with a very, very long-term perspective, I would suggest that the chances are the 76.4% will be tested, but also notice that it's also congruent with parity, which is a big psychological number. So when we're there, what we can expect is a lot of movement. There'll be a lot of volatility around parity and around the 76.4% retracement. So in this particular case, for Eurodollar, I would say a test of the 76.4% retracement will likely lead to consolidation. It'll be very choppy. It'll be very difficult. Your traders who look at volatility, they will see volatility spike up, and a lot of noise from the press as well, actually, because it's such a big number. We'll see lots and lots of stories coming in, and you'll see some stories will say, oh, we're going to bounce from parity. Some stories will say, oh, the euro is going to break down to 95. So what will happen there is there will be a lot of noise around parity, around 101, because it's a 76.4, which is the last man standing, also because it's parity, and it's also going to be on a very major chart. So parity, as you said, it's a very interesting, this is actually a very interesting number in itself, coinciding with the Fibonacci number.
Got it. Makes sense.
Mm-hmm. Okay, shall we move on next?
Let's.
Cable. We saw another example here from December 2016. This is a weekly chart, slightly more useful for the trading audience. The weekly charts give a nice background sense of what's going on. What we have here, we have from December last year, we have the sharp fall into January this year, from 127.50-ish all the way down to 120, and then we bounce very sharply, coinciding with Brexit talk. This bounce from 120-ish, it popped below 120 just for a short time, has already hit the 50% retracement of this December-January fall. So looking at it from here, one would be anticipating extension of cable towards 124.50 and also to 125. And as you said, for Eurodollar, parity is a big number. 125 on cable will probably also provide some reactions as well. But if we break 125, then people will be looking around 126, which is the 76.4% retracement. So I think from a Fibonacci perspective, we've broken the 50%. We're within reach of the 61.8%, and if we break above 125, then all eyes will be on the 126, 76.4% retracement. This is from a purely Fibonacci perspective. The next slide we have euros. Yeah, okay. Euro sterling, an old chart, daily chart again, which is even more useful to the traders. We've seen the fall from the October high, October 2016, all the way down to December. It's quite sharp, especially October. My goodness, big fall. Yes, down to about 83, and then we start the messy euro sterling trade, which I've always tried to stay away from. I just can't get my head around euro sterling. It's one of the monsters that haunts me. So we see this oh good grief. And we say as traders, don't get psychologically or emotionally attached to your position.
Absolutely.
And here's me, I'm lamenting about it, and I'm not even in the market. I mean, this is the trauma I have. So we saw a nice break at the 23.6 just at the beginning of this year. See the huge pop up, pop down. The candle shows it was a sharp rejection. Then we have another little pop down here, then another bounce up, then a steady run up. Again, we did the same thing here at the 38.2. We tested it, came down, then we tried again, we broke it, and then we've reached the 50% retracement here. So from a Fibonacci perspective, we would now need to be looking at other indicators within the market. For example, we would need to look at momentum, we would need to look at psychology, just to have a gauge of what's going on. We would need to look at euro dollar, we would need to look at cable as well, just to see how euro sterling is moving. And and we can actually at a later date, if we get the chance, we can talk about momentum, we can talk about trading psychology, and if your traders are interested, we can talk about momentum studies, we can talk about moving averages. So
Absolutely.
What we can do, yes, excellent, because we can bring together the whole picture step by step, and we can put the jigsaw puzzle together so that the traders who are new can see how all the various aspects of technical analysis all converge and provide a very good model of what's happening. So for now, we focus on the Fibonacci. We've hit on euro sterling, we've hit the 50% retracement. So the question is, can we go to the 61.8? And we would say the classical answer is if we close above the 50% retracement, then we would then be looking at the 61.8% around 89.60. So, and I haven't looked at euro sterling since I made this chart, so I won't say anything because we'll try and keep it pure.
Sure.
So from this, I would say we need to see a close above these 50% retracement, which is around 88.30, and also close with 88.50, and then we could look for a move towards 89.60. That is how I would look at the 50% retracement in this specific market. But you can see also here, the trend has been quite strong. It's very well defined. So we need to look at that also at some point. But from a Fibonacci, we look at we've seen the 50% retracement tested, close above here, and then we come up to 89.60, where again we would reevaluate our positions.
Got it.
So now Aussie dollar. This is also a very difficult market. We have a gain from November this time. We have a fall from November high around 77. Was it 77.80? 77.80 maybe, all the way down to around 71.50 in December. So this October to December fall. I've put in the retracement, and we've had a very steady rally up. You notice that we had a move up here, we popped down, then we made a proper run up, and we cleared the 23.6. We weren't too happy. We consolidated around for a short while, then we went up again. We cleared the 38.2 quite convincingly, and in fact, in the same day, we hit the 50% retracement, right, and we came back. Yes, a little pop above there, and then we came down. Then we've attempted to break above again, and on the chart, we're consolidating between the 50% and the 61.8% retracement. And also, again, we can talk about this in another podcast if you want, about around the 75 psychological level here. So you can see that we're now consolidating around the psychological level as well. So from a right, Fibonacci perspective, yes, we would look for a rally maybe up to 75.40, 75.50, and then we would have to see what happens. Generally, we would expect a pullback from below 75.50 an Aussie dollar. And then as the market develops, we would then, as I said earlier, we would then look at other indicators, momentum, psychology, other markets, to just get a feel for what's happening in Aussie dollar. But for now, the Fibonacci traders will be saying, we've hit the 50%, we're consolidating beneath the 61.8%. If we get to 61.8%, do we keep going, or do we turn off, or do we consolidate? So if we get to 61.8, we will wait and see what happens for that level.
Very good. Now, I think this is this is a very interesting part the one we're getting to here now, which is you've given us a great overview of how essentially how solid, how can I say, how relevant Fibonacci ratios are across very different charts, both in terms of underlying currency pairs as well as in terms of time frames. We've gone from a quarterly time frame, which is pretty much one of the longest time frames anyone would want to
Yes.
look at this, to
Yes.
daily and below and much more smaller and frequent time frames. So we know kind of how the Fibonacci ratios hold up on a chart. But yeah, most importantly for those who are not 100% familiar with actually how to draw Fibonacci lines on charts, how can we do this?
Okay, I will attempt to move to my charting system. There we go. I hope that's visible.
It's perfect.
Okay, excellent. This is dollar yen. It's accurate up to yesterday, actually, the 26th of January. It's accurate up to 26th of January, and I thought we could look at two retracements, and I'll first look at the bigger retracement. So when we're looking at Fibonacci retracements, what we're looking for initially is we need to identify the maximum and minimum points within the trend. So, for example, here we could identify this, the low from early November, from the 9th of November, as a start of a trend. We see dollar yen rallied all the way up to the 15th of December, when it hit around 118.50, 118.60, give or take.
Sure.
So so we can see this move up here. So what we would do is we would be asking ourselves, how low can the retracement go? So the Fibonacci retracement, and the retracements are on all software packages: Bloomberg, Metastock, CQG, all of the trading charting applications which people use. They all have a Fibonacci retracement. So in Metastock, this is retracement level. I identify the low point, which is here, and you see how it automatically draws it all for me. It calculates it all, and So I've basically highlighted this whole trend here, and what it does now is it is automatically put in the Fibonacci retracements for me. So we saw from middle of December here, we saw a quiet trade, which is to be expected because it's Christmas. We saw a little pop higher beginning of January, but then the market began to fall. So when we see this trending here, we ask ourselves, where are the Fibonacci retracements? And the first time we hit was on 11th of January. We hit the 23.6%. We stayed around there, then we broke it. However, you see here the next target would have been 112, which is the 38.2. We haven't managed to reach the 112. So the people who are looking for 112 and it didn't happen, they'd have seen this and they'd have thought, something going on here. We've seen a move back up and we've seen a move back down. They would still be looking for a 112, but as you can see, it's starting to look like dollar yen's getting a bit more bullish here. You see how it's starting to turn up. So now we would move to a shorter time frame and we'd ask ourselves, okay, if this is a move, a corrective bounce in dollar yen, how high can it go? So what we need to do is we need to look at the next relevant trend. So let me just delete this longer term Fibonacci.
Just
clear the chart there. Okay.
1 second, Mike, before you delete that, and before we move on. So I noticed that you start drawing the Fibonacci from the intraday low, as opposed to the close of the candle on the low end of the candle. Why is there a specific reason for that?
Fibonacci retracements generally are used on the extremes of the trading day or the trading week. So whilst you can look at where it's closed, it's always useful to know where it's been. Well, now the close is important for various reasons, but it's also interesting to know how low it went, and how low it went is more useful from a Fibonacci perspective than where it closed. So we would be looking for the absolute extremes within a trend. So we would look for the extreme low in this November-December trend. We would look for the extreme low, which was here, and we would look for the extreme high, which was traded, which was here. Yeah. So we would actually go from the lowest low to the highest high, and we would take these. Yes, we would take these as the measurement points.
Which leads me to another question, and which is a very important one, but I kind of don't want to go here into a tangent too much, at least, in the sense that clearly the Forex market is an OTC or an over-the-counter market. There are a few futures or currency futures exchanges here and there dotted around, but nothing major. So looking at here the this massive traveling down on around the 8th or the 9th of November, it's kind of, how can we tell whether this was just driven by very thin volume and someone trying to play around with the market, or on the other side whether there was substantial volume behind it? In other words, how can we tell how much volume there can be or there has been behind these intraday highs and lows?
I think from a Fibonacci perspective, it doesn't matter whether it was one person who traded at that low or it was a million people who traded at that low. The important thing is that that low was traded. I do understand about, volume, as you highlighted, volume is very important, especially in commodities markets. You need to know how many people are getting busy around these important levels. But from a Fibonacci, we don't need to know the volume. We just need to know how low it traded or how high it traded, what it printed. There are studies which use volume. Equivolume studies come in, for example. You can use volume analysis. But from a Fibonacci perspective, we just look at what traded, what was the lowest point traded, and what was the highest point traded. And the Fibonacci analyst will just use those 2 points to define his trend and his calculation levels. But this also goes back to what I said earlier, doesn't it? It's in the sense that you want to use Fibonacci levels to get a sense of where it can go, what the market's looking at, but you do need other indicators to verify or to give a bit more of a picture, of flesh out the trend and give you a bit more insight. And the volume, as you said, especially in the futures markets, the volume studies do provide very valuable information because it tells you how much action there was at that point. So whilst the Fibonacci person might say, well, the low around 101.20 in November is important, from a volume perspective, it might have only been one person out of 20 trillion dollars traded, you see. So in that respect, it becomes completely, it's nothing. But from a Fibonacci perspective, it is actually the level that we need to measure from. If that makes sense.
Absolutely. Interesting. Okay, good. Okay. I don't want us to get too much kind of sidetracked into a tangent. I think, as you mentioned, volumes are very important in pretty much any market, but in Forex especially, they can be a bit of a tricky measure, yes, due to the fact that it's mostly an interbank over-the-counter market. But anyway, perhaps we can save this for a separate conversation, Mike.
Oh yeah.
I don't want to sidetrack you too much. So we had finished looking at the Fibonacci's, and then you were saying, okay, well now we need to move on and look at some other things to see where we go from here on this chart.
Yes, we were looking at the big November to December rally. Then from December to January, we saw the corrective pullback. Now we've seen this move in dollar yen here, and it's starting to look a bit more bullish. So we're asking ourselves now, how high can it go? So we need to delete. Again, we need to delete again the old Fibonacci's because we're not looking at this trend anymore. We do that. Now we look at the most relevant trend for here. The most relevant trend is this trend here from the 3rd of January, when we've come from around 118.60, we've fallen, we've hit 112.55 here, we've bounced, and we've hit 112.49 here. Now, the question is which level do we use? We know that the trend started here, but where did it end? Now, I would say that we use the 112.49 level. It's the lowest. We basically have a fall from 3rd of January all the way down to the 24th of January, and this is the trend I would identify to as my retracement.
Just so that we are all on the same page, because the numbers can be quite small on the chart. So essentially, you're saying you would use the trend that would start at the highest point of that candle, so the intraday high, all the way down to the lowest point, i.e. the intraday low on the lowest candle.
Yes, there we go. Yeah, exactly. And this is all done on the chart automatically. Yes. So they are the levels we would use: the extreme high, the day high, and all the way down here we would use the day low.
Perfect.
So these are the points we'd be looking at. So we've identified the day high, we've identified the day low. Now we go back to our retracement button, which again is inbuilt into all charting software, and we just highlight the whole thing there, and it does it for us. Now, a point of warning I think is important here is that you see here we have two bars here which suggest we've hit the 50% retracement. We have to ignore these because we are looking at the trend which went from here all the way down to here. So now we're looking at the retracement levels begin from here. So we begin our Fibonacci identification from here in this direction. What we see here is previous history. It doesn't count. We take all our measurements from the low here. So,
sorry, Mike, just to make sure I follow you. So why exactly are you saying that we should ignore those two white and black candles that seem to have tested the 38.2 and then the 50% retracements?
Because within this trend from 3rd of January down to 24th of January, it's a philosophical thing, is that the Fibonacci didn't exist until we traded on the 24th of January.
Oh, okay. Makes sense.
Does it? Getting into philosophy now. See, we don't backtrack for Fibonacci tests. We always go forward from here.
Okay.
So we would look now for tests in this direction.
Okay, so just to clarify, so what you're saying is that you take the highest high, the lowest low, you draw the Fibonacci's, and then from the lowest low onwards, or if it's an uptrend from the highest high onwards, that is when you would start actually looking at Fibonacci retracements and using them. Is that what you're saying?
Yes, exactly. Yes. So we basically start our Fibonacci identification from here, and we see already we've hit the 23.6 two times, then we broke up.
Right.
And you notice how here on the 26th of January, it literally smack bang on the 38.2% retracement. I think the 38.2%, if I squint, is about 114.80, about. And my data suggests a high of 114.85. So basically, we exactly hit the 38.2% retracement and then came back. Now we would look, so close above this high around 114.80.85. We would then look for a move towards 115.50, 115.60, which is a 50% retracement. So the Fibonacci traders are looking for extension towards 115.50 in the coming days. And then if this also breaks, they will then be looking for a break above 116 towards 116.30, which would be the 61.8% retracement. So the Fibonacci traders, they will have seen the 23.6% broken convincingly. They will have seen a very quick test of a 38.2% retracement. They will probably be staying bullish and anticipating a move to 115.50.60. And then, as we said before, when you mentioned volume as a secondary or another market indicator, they would look at momentum. They would be looking at their own indicators just to see how the market is performing, and they would then make a decision as to whether they believed the market would go to 61.8%. But for the Fibonacci chaps, they'll be looking for 115.50, and the close above 115.50 would take us up to 116.30. So I think I'll just use that as a single example. If we could spend all day going through so many different markets. We could move into different asset classes, but I think the interesting thing from here is for the traders to see that the Fibonacci numbers do work, the retracement levels do work, and they are watched. In fact, they're one of the most famous watched indicators in the global markets. Everybody looks at Fibonacci retracements. They may draw them from different levels, but that becomes a personal that's a personal choice as to where you define the trend. My definition here is a classical definition of a trend, and this classical definition of the trend is what people will generally be looking at in dollar-yen over the coming sessions. So from the time of chatting, we will be looking for 115.50, and then the Fibonacci people will be looking for a move up to 116.30. But as I said, the Fibonacci retracements are in all markets, they're in all time frames, and they're everywhere. Basically, you can find them everywhere. You just need to identify your trend, your high and your low, and you use your charting software, and then you can see where they are. But as Alberto, you were saying, and as I've highlighted, it's worth using Fibonacci's as an addition to other charting indicators. And if it's possible, we can talk about in a later date. We can talk about moving averages. We can talk about momentum. We can talk about patterns even, and we can maybe even go into psychology and talk about market sentiment. And maybe on a more advanced way, we can talk about how the FX markets are interlinked with the equity markets, how the FX markets are linked in with the commodities markets. So then gradually builds up a global picture of how the markets move on a cross-asset basis. And this extra information from a commodities perspective, from an equities perspective, from a futures perspective, I think this gives more learning, gives more education, it gives more background to the traders, and it helps them understand on a deeper level what's actually moving and why it's moving. If that makes sense. Oh, excellent.
Absolutely. It's interesting you mentioned psychology, Mike. Just very briefly, I wanted to kind of quickly ask you before we draw things to a conclusion. Um, I know because I get asked pretty much every day questions around psychology, um, and even if I don't get asked, or when I don't get asked, I know that something that a lot of our members, of our students, struggle with is psychology, the management of emotions, the management of losses as well as wins. So I wanted to ask you from your time at Lehman Brothers. Clearly, you were handling, as you mentioned, positions, in the kind of three-quarters to $1 billion worth of trades. I wanted to ask you what is the number one thing that stuck with you from being thrown so deep in trading at such a young age, in such a young point in your career. What is the number one thing that stuck with you, and perhaps what learning point could you share with our students in terms of psychology and psychology of trading?
I would say the two things I think which are important, which I learned. One is, do not get emotionally attached to your position.
Of course.
I know, yes, it's very easy to say it, but when you have for example, if you're a trader and say for example you're long dollar yen, and
Sure.
you're long dollar yen. Let me go back to your long dollar yen, and here we are. We've hit the 38.2% retracement, and we're thinking it's going higher. Now, suppose we bought dollar yen, say, I don't know, 114. So we bought dollar yen at 114. We saw it reach 114.50, and now we think it's going up to 115.50. So we're making money. We got it right. We then, from a human perspective, we put ourselves into this position and we say to ourselves, look what we did. Look at how good I am. I got this right. I'm brilliant. Look, I'm
Right.
making money. I know what I'm doing. See, and this, you then start to emotionally attach yourself to the trade. It goes up to 115 figure, and you're thinking, yes, look at me. It goes up to 115.20. Yes, look at me. I'm really good. But then, what happens if it doesn't do that? What happens if it comes down? It doesn't hit there, and it goes below 114 figure, and you're now losing money. You've gone from being brilliant, I'm the best, I'm the market, I've beaten the market. Now the trade's going against you. You're looking down, you're thinking, oh dear, a few naughty words might come out. and then you're thinking, I'm going to hold on to this because I was right the first time.
Right.
So now you're not making a trading decision, you're making an emotional decision. And that's the danger a lot of traders face. And it's a very difficult one to break, is don't get emotionally attached to your trade. You have an idea, dollar yen's going up, you say, okay, I'm going in at 114. If it gets to 115.50, I'm out. Thank you very much. I've made my bit of money. And you follow that. You follow your plan. You have no emotional attachment to this. You've just laid down the law to yourself. I'm going at 114. I'm going out at 115.50, and I'm going to walk away.
Absolutely.
That is how a lot. That's how a lot of the best traders do it. They will do that. They will put it in. They'll put in their entry position, their exit position. They will put in their stop loss, and they walk away. And they come back and check. And if it's made money, well, that's good. If it hasn't made money, well, okay. My stop loss covered me.
Yeah.
So it's this emotional attachment which needs to be managed, and it's very difficult. But when a trader can get past this emotional attachment, things become a lot clearer. Your execution rate improves because you don't get this shaky finger, too scared to hit the sell button, or you're too scared to take the loss. You just take it. You think, oh, okay, fair enough, that was wrong, and you click, there you go, and I'm out. And you're neither happy, you're neither sad, you are just emotionally detached.
Absolutely.
Now, Yes, and then the second thing I learned, which is just as important, I think, is risk management.
Of course.
How many times does a trader go into a position? He'll go long dollar yen at 114, and this position will be too big. Every single pip, he's sweating. The trader's sweating because the position's too big. I remember years ago when I was at Lehman's, I was talking to a very, very good, very successful trader then, who's now a fund manager, and he said to me, his position in dollar yen was too big. He says to me, Mike, I need to get out of it because every time Sakakibara sneezes, I lose $10,000. So he says that was him saying I need to get out. That was him managing his position. So I would say also to the students, to the new traders, well, to all traders really, it's always a good revision is to make sure your positions are within your risk parameters. Manage your risk. It's as you said, Alberto, it's money management. And when your money management is good, when your money management is comfortable, then you don't get as emotionally attached or emotionally affected by the moves. And now when we say risk management and money management, that's another thing you talk about, because money management is different things for different people. You could have a trader who isn't comfortable with a position unless he has a 5 pip stop loss. Some traders will say it's okay, I'm happy with a 20 pip stop loss, and some traders will be happy with no stop loss. They shouldn't be. They should have a stop loss, but a stop loss is a personal decision, and it's an individual choice based on where that trader is at the time the position is taken. So I know it sounds a bit wishy-washy, and it sounds I'm trying to bounce around the definition, but a Warren Buffett stop loss would be different to a Bill Gates stop loss. It would be different to a Jim Cramer stop loss. It would be different to my stop loss. It would be different to your stop loss.
Sure.
Because it depends on the psychology of the trader as to what they are prepared to risk and what reward they are looking for.
And if I may add, you reminded me as you mentioned that trader at Lehman Brothers. There's something that I realized actually a couple of days ago as I'm writing another book, and I was kind of looking back and thinking and doing some research on why is it that, generally speaking, the hedge funds and the investment banks and the traders within those institutions are making huge fortunes most years. I wouldn't say every year. Every institution will have a losing year every now and then, but generally speaking, those institutions, those traders are doing extremely well, both for their companies, as for their shareholders, as well as for themselves, their own personal income. And I was asking myself, why is it that such individuals are so profitable, and why is it that the average retail trader? I was reading a study from Berkeley University that actually demonstrated how 95% of retail traders are not profitable. And I kind of boiled it down to two things. The first one is, whenever a junior trader joins a hedge fund or a bank, clearly there are always senior traders. So around him, who will formally or informally give him coaching and training and guidance. So there's always an element of mentorship and follow someone who's done it before and learn from him or her, which unfortunately, unless you proactively join one of the coaching programs, and we offer a number of them. Unless you proactively join, it's something that in the retail world does not happen. The average retail trader is just sitting at home, sitting in his office and trading in isolation. The second thing that kind of also realized is there's an element of, there's a team element. When a trader is trading within a fund, within an investment bank, clearly he's in an office, in an environment, he's got other people around him who are doing similar things to him, if not the same thing. So there's a community element, and they all formally or informally learn from each other, which, again, in a retail trading environment, the isolated trader has typically no mentorship, and I highly encourage every trader to have at least one mentor, if not more. And there's no team dynamic, there's no group coaching, there's no learning from what mistakes other traders are making.
Exactly.
Anyway, I digress. Just coming back to our point about psychology. There's a number of things that the hedge funds, that the investment banks have in their favor, that some retail traders are taking advantage of in the forms of the internet and group coaching and trading rooms and online trading courses. But unfortunately, the majority of them are not, either because they don't see the value, which is a shame, or they're just not aware of them. But anyway, I digress. That's one of the reasons for why we're here, to make sure that as many people as possible have access to the insights, such as yours, Mike, that kind of institutional players have, and it's our job to give the retail access trader to these insights.
Yes, exactly. I mean, can I just add, it's also, when you're in the team element that you're talking about, you also pick up different things going on in the FX markets. So you might have a position in dollar yen, but then somebody on the dollar Swiss desk will be saying something or hearing something which could affect dollar yen. So you're getting education, you're getting input from all around everybody, and you're automatically distilling it into your position. You're always asking yourself, does this affect my position? Does this affect my position? So you're always looking at what's happening in the background. And as a retail trader, if you're alone, you don't have this. You don't have access to this background noise, which could be useful. But if you have a mentor and you're in contact with the mentor, and the mentor is in the market, the mentor will be able to just send you things that could affect your position. The mentor will be able to point you in the direction of something. For example, if you have an Aussie dollar position, your mentor may say, Mike, go and look at gold, because gold looks like it's going to do this, and this could affect your Aussie dollar position. Or if you have dollar CAD, dollar Canadian, look at oil, because oil and dollar CAD are correlated. So you get this extra input, this extra learning, which sticks with you, especially when you're trading a position. You're actually hyper focused when you have a position, and a mentor is highlighting different aspects of the markets which could affect your position. When you wouldn't hear this, you wouldn't know this if you're sat in isolation trading. So as you said, a mentor, talking to somebody who is there, is very, very useful for a retail trader.
Absolutely. Very good, Mike. We've got so much to talk about. I know we are a bit short on time. I think we've identified a number of points for conversation here that we definitely have to explore in follow-up podcasts.
Yes.
Before we wrap things up, how can people get hold of you, Mike?
People can email me. My email is on the front slide. It's on the first slide, mike.m@xatsuk.com. They can go to my website, www.xatsuk.com. There's an opt-in button there, says they can subscribe to my reports, which I do. My reports cover FX markets, they cover equities, they cover commodities, and they go into depth a little bit more. They are a bit more, in inverted commas, advanced. But if they read them, they can understand the vocabulary, they can start to understand the thinking process, they can get exposure to how momentum functions are used, how my proprietary indicator is used, and it helps them educate it gives them more information. And as our podcasts go on, they will then be able to see a bit more of what we're talking about, and be able to apply it better to their own systems, and maybe even to help other people.
Fantastic. Very good. So to recap, the website is xatsuk.com.
Yes.
Very good, Mike. It's been a true pleasure having you with us. So thank you very much for making the time to be with us today.
Oh, it's been fun. It's very interesting. It's very interesting.
Trading is such an interesting topic, and it's a very profitable one once you get the hang of it. Very good. This has been Alberto Pau. This was a podcast with Mike McDonald from Cross Asset Technical Strategy UK. Until the next time, thank you so much. Bye bye.